Alright, welcome everyone to a new video on the channel. Today, we are going to go over everything you need to know about dead cat bounces. These are patterns that occur during bear markets, which essentially represent a failed rally. These rallies occur after a sharp event decline, meaning that there's something that occurred to the asset itself on a more fundamental level. For instance, this event could be the loss of a very important patent, or as we've seen many times in the past, a company filing for bankruptcy. So what we see happen is naturally the stock price going down, then come in all of the bargain hunters, the bottom feeders, the people who get blinded by this so-called discount in the stock price, who haven't necessarily had the time to truly digest what this news actually means for the company. So nevertheless, all of the bottom feeders come together, buy up the stock, put upward pressure, which makes the price increase. Oftentimes, these moves can occur in a very violent manner, especially when fueled by a lot of short covering. If you don't know what that is, that would be a very important topic for another video. These contrarian rallies can even retrace up to 25% of the previous move downwards, which can often mislead investors into FOMO buying and thinking that this is a meaningful change in the direction of the trend, when in reality, it simply isn't the case. Dead cat bounces are not always easy to identify in advance, but for the more experienced technical analyst, it's definitely possible to get certain clues by looking at the internals of this rally that we're looking at, by looking at various different indicators such as volume, momentum, relative strength. If these are things that you would potentially be interested in learning more about, I have made multiple videos in the past on my channel on these specific topics. But simply speaking, on a very high level, the best entries that you can get on a stock are when you start seeing signs that a bottom could be forming and that a potential reversal could be in play. Of course, the worst time to buy would be at the top of a rally. Sometimes it's best to stay out than to FOMO buy in at a very bad price. Of course, none of what I'm saying constitutes of financial advice. I'm not a financial advisor. I don't know anything about your personal financial circumstances, nor anything about your risk tolerance levels. So ultimately, it's up to you to take accountability for your decisions. One thing's for certain, and this is something that I say very often to anybody who is starting on their journeys as an investor or as a trader, is with knowledge comes confidence. And with both of those factors comes better decision making. In any case, if you want to learn more about technical analysis, I made an entire 100% free series on my YouTube channel. The link to the rest of the videos will be down below. Thank you guys so much for watching. If you wouldn't mind just dropping a like for me, that would be greatly appreciated. I'll see you guys in the next one. Peace out.